Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. The AI boom is feeding on itself. Chipmakers, cloud giants, and model makers are increasingly tangled in a web of investments, each funding the other's growth. Isn't this what happened in the dot-com bubble?
I want to know what happens when suppliers start financing their own customers, lending them money to buy their own products. And in today's dumb question of the week, are bubbles always bad? All right, let's get into it. So, Romin, one of the annoying things about capitalism is that you've got to find customers for your products. And if your products are really expensive, you need to find customers who have a lot of money. They need really deep pockets. But what if your customers don't have enough money to buy your products? Are you stuffed? What can you possibly do here?
Well, if you've got lots of capital, you can give them some of yours. And that's obviously a worrying development, okay? Because we've seen this show before.
Are you thinking about the dot-com bubble there?
Yeah, but I mean, it probably isn't the first time this has happened. New technology comes along, very capital intensive, it needs capital from somewhere, and the people who are going to be able to provide that capital may be deep-pocketed companies themselves. But there are other analogues. For example, if you think about what happened with China and the US, you could say that China was essentially lending money to the US to buy its products.
What, by buying treasuries, you mean?
Yeah. So China would make stuff, the US would buy stuff, that would generate dollars for China, which it would then park in treasuries, which are effectively lending money to the US government.
One big happy circle, though. It's not going to go wrong, Romin. That's just global trade.
I'm so old and cynical. As I get older, I just feel as if I'm seeing the same patterns repeat themselves. But, that's not to say it's a bad thing. It's just that I think it's good to understand the risks. So I think it's worth teasing apart what's going on right now.
All right, well, let's focus on this sort of spate of AI deals we've seen. We've seen a huge amount of deal making in the last few weeks. And they're often using, I guess you could say, innovative financial structures, if you're being kind, certainly unconventional ones. And I think the big two players here, which seem to be involved in everything, are NVIDIA on the chip making side and increasingly OpenAI on the software development side. Now, we may as well start with one of the biggest deals, which is between those two companies. So NVIDIA pledged to invest up to $100 billion into OpenAI to help them build new data centers. And no surprise here, the chips that are going into those new data centers are NVIDIA GPUs. So effectively, NVIDIA is giving money to OpenAI, and OpenAI will be giving it back to NVIDIA, and then the data centers and the chips will rise from the ground.
So you can see why both of the companies benefit from this relationship. OpenAI gets capital to build infrastructure on which its models can run. NVIDIA gets a place to park some of its capital. And of course, people are just throwing capital at NVIDIA right now. And the same's true of OpenAI. So it's very clear that the music's still playing, and we've just got to keep on dancing around the musical chairs.
I think if this was the only deal we'd seen in recent weeks, it would be fine, right? It's two big players, investors love both of them. Yeah, they should work together. It's a symbiotic relationship. But that is not the only deal we've seen. So NVIDIA has also done a deal with CoreWeave, which is a cloud provider and a major customer of NVIDIA. They buy a lot of their chips. And this is a bit of an unusual deal because CoreWeave has taken those GPUs from NVIDIA and then used them as collateral to raise debt because those chips are obviously valuable and they're an asset. So, why not lever up the chips? But obviously the risk here is that they'll build way more capacity than they can sell, CoreWeave this is. But underpinning this deal, NVIDIA has apparently agreed to buy any surplus computing power back from CoreWeave. It's a bit of a strange one to unpick.
Yeah, I don't like the collateralization here because if something goes wrong, well, if there is overcapacity, well, it's going to be all the more painful because of that collateralization. And what seemed to defray the risk, which is, of course, the whole point of having some kind of collateral on a loan, would actually amplify the risk. So this feels like it's going to be a problem down the road if a lot of these forecasts about the demand for capacity don't materialize.
I just would put myself in the shoes of a lender here. if I'm a bank or whoever, and a cloud provider comes to me and says, I've got all these chips, can I raise debt against them? And you say, yeah, sure, here's tens of billions of dollars. If it goes wrong and they default on the debt and I have to call it in, what am I going to do with 1 million GPUs? Can I sell them? Because presumably the situation when the cloud provider defaults is that there's not enough demand. And then who's going to buy the chips from you in that situation? Or the chips just become outdated and there's a new model and you're just left with this sort of dead inventory.
No, I think that's more of a risk, the second one you pointed out, because if we use an analogy with real estate, if a bank lends a customer money to buy a house, well, they can use the house as collateral. That's completely normal. If the person can't repay their mortgage, well, then the bank can repossess the house. It's still got value. Now, in a big recession, presumably, the value of the houses would drop, but it would still have a fundamental value later on. Whereas with the GPU, the question is, would it still be useful? Would it still have value 3 years after that because some other chip would have come along? So that would be my concern, which is that this is a very cyclical business. They've used their own inventory as collateral, but the inventory itself amortizes fairly quickly based on technological improvements. And of course, if you consider what's happening with China, China's trying to develop its own set of GPUs which are going to compete with those in the West. And if that's successful, they could massively undercut some of these GPUs. So that's quite a risk. I don't think I'd be comfortable having that loan collateralized by GPUs.
Now, we're going to be drawing a lot of circles today, but I think we've completed the first circle there. We've got NVIDIA, a chip maker. We've got CoreWeave, a cloud provider. And we've got OpenAI, who's building foundational AI models. And they're in a nice loop together almost there. But we're not going to stop at one circle today, Romin. Let's start drawing another one. So there's a deal now between NVIDIA and Intel, another chip maker, one that's been a bit down on its fortunes lately. They've kind of been left behind, haven't they, in the AI race? And NVIDIA has really leapfrogged them. So I think the White House has been quite keen to save Intel. And we know that the US government has bought a 10% stake and a kind of golden share. And I'm guessing behind the scenes has been pressuring NVIDIA to join the party. And NVIDIA has now committed, I think, $5 billion for a 4% stake in Intel and agreed some technological collaboration. Bit of an unusual thing, though, isn't it? To see what should be two major rivals, well, teaming up in a way.
Yeah, I think this is partly due to political persuasion, as you say, because what the US wants is domestic chip manufacturing capability. Now, it might be tempting if you're Intel to say, look, we won't even bother manufacturing chips anymore. We'll just outsource that. We'll use our expertise to design chips. And that way, you get the economies of scale for whoever's actually manufacturing the chips. And we can focus on what we're good at, but also what might be more profitable. It may not be very profitable to make these chips in the US, or it might require a lot of investment in infrastructure to do so and carry on doing so. But what effectively has happened now is that there's a kind of poison pill in place which says that the US government won't let Intel do that. They won't be able to shut down manufacturing of chips on US soil because that's the whole point of what the US is trying to achieve. So that is worrying from the point of view of shareholders of Intel, I think.
Is it? Or is it just saying Intel's too big to fail and strategically important and is now a quasi-state-owned enterprise to some degree?
Yeah, as long as it made profitable decisions based on this new initiative, yeah, that would be fine. But how profitable will it be to manufacture chips in the US?
I don't know. It depends on state subsidies, I guess. But if you think about it, the AI hype has boosted any company remotely involved in AI, right? Their share price has risen and the multiple investors are willing to pay has gone way up. Intel's missed out on that because it's not really been in the AI race. To me, this smacks of the government desperately trying to sort of put its arms around Intel and drag them into the AI hype bubble.
Maybe they'll succeed with that. Who knows? But I think the problem that Intel faces is that creating these manufacturing plants for the most advanced chips is really expensive and requires a lot of expertise. Now, NVIDIA itself, of course, is not a manufacturer of chips. All they can share is knowledge about design of GPUs. The people who have all of that expertise are TSMC. So Are they going to give secrets about how they manufacture really pure crystals required to create these chips? I doubt it. I think the company you'd want technical expertise from wouldn't be NVIDIA, it would be TSMC.
But the company you want money from at the moment is NVIDIA. That's certainly what's happening here. Now, there are other chip makers in the industry, notably AMD and Broadcom being the other big one. And OpenAI has recently announced deals with both of them. The one with AMD is particularly interesting. So OpenAI has agreed to purchase, a bucket load of chips from them. And as part of the deal, it's getting this kind of warrant where it can acquire up to 10% of AMD. That's a pretty chunky stake.
I think the problem with one of these Ouroboros type structures where you've got a snake eating its own tail is that everything's fine while the music keeps playing, but the minute the music stops, you start to pick apart all the linkages. So look at any financial crisis and you'll see that happening. Companies where you didn't realize there was a linkage suddenly start to come to the fore.
But maybe it makes sense from OpenAI's point of view. It needs these chips in its view. It thinks it's in an arms race. The demand for compute is going to go way up in the coming years, but it doesn't have enough cash on hand to be able to buy these chips. But what it is really good at is selling the dream to investors. And you could argue, Roman, that some of these deals kind of pay for themselves. Now, how is that possibly true? Well, the stock prices tend to rally very hard the day after these announcements are made. So AMD's stock was up almost 30% after it announced the deal with OpenAI. Broadcom shares rose 10% following its deal with OpenAI. From the point of view of AMD and Broadcom, their market cap just went way up, and sometimes by more than the value of the deal, right? So it kind of paid for itself. And I think the reason OpenAI is getting a stake in AMD as part of the deal is it wants to capture some of that value for itself.
But again, market prices are very fickle for equity. And if there was some new development which would knock these prices for six, well, that could get reversed over the course of a day. So I'm not convinced that share price increases paying for the deals is going to cut the mustard. I sound so cynical, but I just think it just feels as if there's some misallocation of capital going on here.
It's hard to know, I think, because the risk with all these kind of deals, which are classed as vendor financing, really, that's the term, where a supplier is giving money to its customers to buy its products. The risk there is it creates artificial demand. Both companies' P&Ls are improved because there's orders being placed that wouldn't have been able to be placed otherwise. There's revenue going on the books of both companies. But are people actually going to use that capacity is the question. Because if they don't, then the music stops playing eventually.
And if I wanted to play devil's advocate, I could say, well, OpenAI and other AI companies are driving a lot of this demand because they're creating ever more CPU-intensive applications. We've recently seen the release of Sora 2, which is this video generating app, the next generation of it at least, which does look absolutely amazing. But the US solution to AI seems to be just throw more hardware at it. Now, indirectly, that now becomes throw more cash at it. So that's fine as long as the demand ultimately does materialize.
There are some signs that there is massive demand there for AI. Like OpenAI has almost 1 billion weekly users, it claims. I don't think there's any company that's scaled as fast as that, ever.
And I think the growth in users of Sora 2, which isn't available in the UK, I have to say right now, that has been more rapid than the uptake of ChatGPT itself. So as soon as they create these new advances, people just jump to the front of the queue to try it out. But then the question is, are there competitors? At the moment, there aren't that many competitors, so they've got essentially a captive market. And the other question is, how much are people going to pay for it? Is it going to be worth an additional £20 a month, $100 a month? What is it worth? And is that going to pay for the additional infrastructure that's required here?
When you just look at the numbers on a napkin, it's hard to see how it makes all that much sense, financially speaking. So OpenAI has basically announced all these deals, which could lead it to spend more than $1 trillion on new computing power. Fair enough. But let's compare that to its revenue. This year, it expects to generate around $13 billion in sales. Now, I'm not a mathematician, but there's a big difference between 13 billion and 1 trillion. That's going to need exponential sales growth to make it make sense. Maybe they will do that, but maybe they won't.
That is a gamble. But at the moment, we're still seeing this parabolic growth in the uptake, the use of these tools. And I think everyone you speak to is seeing it impinge on their life. For me, I think the biggest change has been an interface you can talk to. The kind of thing you saw on Star Trek has finally become mainstream. Because the natural interface for a human is speech. Of course, you want something you can talk to. In a sense, some of the other applications have just improved, things like facial recognition, things like the protein folding problem. Those may not have been solvable as well as we can do now with more resources. But I think the huge change has been in the interface. But once you go beyond that, okay, everybody instead of typing on a keyboard can now speak to their mobile device, to their computer.
And their glasses soon.
Yeah, and their glasses. But is that going to justify all of this spend? That's the real question. And I don't think anyone can answer it, least of all the companies who are caught up in the euphoria.
And what euphoria it is, Romin. If we look at AI-related stocks, and it's a judgment call what falls into that bucket, right? Because nothing's purely AI on the listed market. But let's say, by some estimates, since the launch of ChatGPT in November 2022, AI-related stocks have accounted for 3/4 of S&P 500 returns, 80% of earnings growth, and 90% of CapEx growth.
So the market's one thing, the equity market, and here we've been talking about numbers from individual companies. But if you look at the aggregate US economy, some people have said, and there's a nice thing from Jason Furman here, that AI spend alone has essentially taken what is a US in recession and turned it into a US with fairly healthy growth. So due to this increase in spend on data center infrastructure, the dollar value contributed to GDP growth by AI data center build-out had surpassed US consumer spending for the first time ever. And this is from Jason Furman. Now, if you're not familiar with US GDP and its composition, that is absolutely staggering. To first order, the US economy is consumer spending. It makes up 2/3 of US GDP normally. So for infrastructure, for data centers to overtake that is utterly remarkable.
Well, it's overtaken it in terms of contribution to growth, right? The change in both.
And on that basis, it accounted for 92% of GDP growth.
It is staggering. I guess you could say, well, if the companies weren't spending it on AI, maybe they'd be investing in something else. So perhaps we wouldn't have a recession.
Well, Furman actually turns it around. He says that absent the AI boom, we'd probably have lower interest rates and electricity prices, thus some additional growth in other sectors.
Yeah, have you seen the graphs of US electricity prices nearby data centers? They're going up really rapidly. Presumably that's going to create some kind of popular pushback.
I still remember the pushback on Bitcoin, which is that it was very energy intensive. But now that's just dwarfed in comparison with what's going on with AI. But I'd argue that AI is more useful anyway. So this is a better use of that energy.
I did see one stat which was absolutely crazy, which is that if you look at these recent deals OpenAI has announced with chip manufacturers, so NVIDIA, Broadcom, and AMD, total that all up and it's around 26 gigawatts. What does that mean? No one knows what that means. Well, it means enough power to meet the summer electricity needs of New York City more than 2 times over. New York City's got a lot of skyscrapers with a lot of lights.
And a lot of air conditioning in summer. But it's also interesting that they express it in terms of energy. If they talk about the new build capacity for data centers, it's often expressed in terms of gigawatts.
What does that tell you? That it's more about the kind of sheer scale of these things than any kind of proprietary technology?
Well, for me as a physicist, it makes it really clear that they've got to use more energy efficient computing. That's the real breakthrough, I think, that's going to come off the back of this. There are lots of alternatives to what we do right now. For chips at the moment, what you get is you get electrons sloshing back and forth inside a CPU. There are lots of other ways of doing computing which aren't so energy inefficient, which don't depend on the sloshing and which are much faster.
Infinite monkeys with infinite abacuses?
Well, you can use these weird things like electron spin instead of electron slosh. So you can make these propagation of waves in electrons inside the CPU rather than making the electrons move themselves. That's much more energy efficient. So you have things like magnonics, which is spin wave logic, all these things which are very obscure right now, but which could utterly transform this whole ecosystem and the energy and the costs that go into it.
I suppose there's three places efficiency gains could come from. There's what we're talking about here, which is less power-hungry chips. There's also algorithmic improvements in the AI models themselves, so they get to the solution with less processing power. And there's also, at a fundamental level, generating energy in a more cost-effective way. I suspect the solution comes from a little bit of all those buckets, but the best one for society would be cheap energy.
And of course, hand in hand with this new presidency, what we see is a move away from renewable energy in the United States towards more fossil fuel usage. So I think the repercussions of some of these transformations could be quite negative, certainly for the United States. Whereas elsewhere, it could lead to really some interesting developments in terms of renewable energy, but also the way our grids are structured and the way we generate energy day to day.
I see that people like Sam Altman at OpenAI and Jeff Bezos, they're talking about, well, the solution is going to be solar cells in space and a lot sooner than you think.
Yeah, that's one solution, I guess. We'll just have to see how cost effective it is. These people always drink their own Kool-Aid. I think you've got to temper it with a bit of rational thought. But it will be transformative, but it may be transformative in ways that we just can't predict.
How's this for Kool-Aid? I'm going to quote the Wall Street Journal here. Sam Altman recently told employees that OpenAI wanted to build 250 gigawatts of new computing capacity by 2033, a plan that would cost over $10 trillion in today's money. He said that OpenAI would have to create new financing tools to help fund this massive build-out, but hasn't shared details on what this would look like. Now let's put that in some sort of context. 250 gigawatts. Before, when we were talking about this crazy amount of new power they've announced, that was 26 gigawatts. So we're going up another 10 times. And I don't know how much more innovative you can get on the financing models.
But also the infrastructure. You've got to get energy from A to B. And again, that's no mean feat. Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 stocks and shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Every analyst right now is looking at all these numbers, and I think really trying to work out how to make the cash flow model make sense, right? So in terms of how much revenue AI companies are going to need to generate to pay for all this, some consultants at Bain & Co. estimate that it's going to need $2 trillion in annual AI revenue by 2030. Now, to put that in context, that would be more than the combined revenue that Amazon, Apple, Alphabet, Microsoft, Meta, and Nvidia made last year. It would be an unprecedented scaling of a new technology were this to pay off.
Yeah, I don't think that's going to happen, unfortunately. So I think it's pretty clear that there is too much euphoria about this technology and too high an expectation about the revenues it can generate.
So what are the risks here if that doesn't materialize? Obviously, the value of these AI companies could fall if they don't live up to the hype. But going back to these circular deals we've been talking about, do they generate risks over and above that?
I think they do when things go into reverse. I think if there is a lack of demand or some new technology which makes a lot of these chips obsolete. So let's just take some extreme example. Let's say that someone in China discovers a photonics chip which can compute more rapidly with a fraction of the energy requirements than the chips which are currently made by the existing manufacturers. Well, Nvidia's stock's going to crash. So's that of AMD. So would Intel. All of these things which are now interlinked would fall simultaneously on that news, probably on the day it was announced. So just think what impact that would have on the US stock market, which is now fully embedded in this dream, where about a third of the US market is somehow locked into this AI narrative. I think that's a huge risk.
There's definitely that risk that they get disrupted by an external force. In your example, Chinese innovation. There's the other risk we hinted at, that demand just doesn't live up to expectations. Maybe the technology doesn't get a lot better than it is now. Or maybe people just get sick of trying to use AI for stuff. These things could happen. I'm not saying it's likely, but it could happen. But I think on the financial side of things, there are risks that are unique when you get this kind of vendor financing taking over. One which we mentioned already is that it obscures true demand because you're building out capacity so fast in advance of what you anticipate people will use. I think there's also risks around the sort of financial reporting and how it becomes much more opaque because revenue is boosted artificially, valuations go up on the basis of that, and often these companies are using off-balance sheet vehicles, which kind of disguises the debt.
Yeah, reporting for things like private credit are just not as good as they would be for a publicly listed debt issuance, for example. And we've got a classic combination here, which is leverage combined with opacity. You've got structures which people don't fully understand and can't find out about, combined with massive borrowing. Now, that doesn't always end in disaster, but the odds aren't great.
Yeah, I think it's reasonable to get a bit nervous when you see special purpose vehicles being created. As we said, off balance sheet with large amount of leverage, and it's not necessarily showing up when you look at the financial reporting of the companies themselves.
Now, I think there is an issue here. People have compared this AI bubble with the one that we had in the dot-com bubble, and they're drawing certain analogies between the two. There was vendor financing at the time. Companies like Nortel, companies like Cisco were lending money to people to buy their own products. However, when that bubble imploded, I don't think it had such a large effect on the economy as we'd see this time around. And that's because of the scale of the infrastructure and also the fact that it draws in other industries like the energy industry and, of course, the finance industry. A lot of banks have lent money in order to blow up this bubble. Now, that in turn suggests that if things did go into reverse for whatever reason, then it's going to be more painful for the US economy as a result.
I think you're probably right. And you mentioned Cisco there, who was probably the poster child of the telecoms and dot-com bubble and vendor financing. So there's a good piece in Bloomberg recently where they put some numbers on this. So the vendor financing that Cisco Systems did in the late 90s meant its revenue rose from around $2 billion in 1995 to almost $20 billion in the year 2000. So in 5 years, it 10x'd its revenue. And in fact, that made Cisco very briefly become the most valuable company in the world as the internet bubble took off. But when this investment cycle came to an end at the end of the 90s, a lot of the companies that Cisco had lent money to went bust. And that had a twin effect, really. Obviously, they lost a load of revenue because those companies weren't there buying their products anymore. But it also had to write down the value of its own investments in those companies on its balance sheet. So it affected the income statement and the balance sheet of Cisco and led to a 90% fall in its stock price. These things can happen. Big companies at the wave of a bubble take a huge whack if the bubble pops.
So it all sounds pretty negative from our point of view, doesn't it, up to this point? But what if this isn't a bubble? What if this is something which is going to transform society and it's going to generate the revenues which are required to keep things afloat? Not just that, but to actually become highly profitable in the future. Now, there are 3 points that are made by a note from UBS, which I think are kind of interesting. The first one is that while these circular deals are very large, they're still not overwhelming compared to the huge revenues generated by some of these companies. So, for example, the OpenAI NVIDIA arrangement only represents about 13% of NVIDIA's projected 2026 revenue, which is a staggering $270 billion. And if we compare this with the dot-com bubble, remember that a lot of those companies were not profitable. A lot of them were just burning cash, whereas this time around, the companies involved are largely massively profitable. And then the final point is about valuations. If you're comparing the price of a stock with a negative earnings number, well, of course, that's a crazy multiple. But this time around, at least there are solid baseline earnings and also very strong earnings growth behind this bubble. That in turn means that if things do reverse, well, at least some of the companies will come out of that wreckage looking pretty strong because they've got very strong balance sheets and fundamentally valuable businesses.
I'll just read a little bit from that UBS note. It says that in the late 1990s, internet leaders traded at a forward price to earnings ratio of around 60 times, whereas today's AI giants are closer to 35 times, with stronger balance sheets and more predictable earnings streams. And I think that's a good point, is that a lot of this investment is being funded out of the free cash flow of healthy businesses. And from a societal point of view, there's one thing I might worry about if this isn't a bubble, is that now we've got all these really tight interlinkages between the chip makers and the cloud providers and the model makers. From a consumer's point of view, how is that going to be a competitive market? It certainly opens it up to some kind of price fixing, right? Explicit or just implicit, whereby if all the AI companies are somehow in cahoots, mutually financially dependent, or even just incentivized in the same way not to compete so hard, we might be paying a lot for our AI needs, more than we otherwise would.
Yes, not as if there's a cottage industry which could compete with these giants, because you need huge resources in order to run one of these models. So what it looks like is pretty much the same things that we saw with the advent of automobiles, which required petrol to run, gasoline if you live in the United States, where we just got a series of monopolies created off the back of this innovation. And it's looking like we're going down pretty much the same route this time around.
So if it isn't a bubble, then a monopoly is bad for consumers, but it might be good for investors in these companies. And just to go back to UBS's point about how a lot of these big tech companies are extremely profitable, their earnings growth is strong. Obviously, that's true about NVIDIA and Amazon and Google. But then you could say, well, that's not true of the model makers. OpenAI doesn't expect to be profitable this decade. It's burning through cash. The same is true of Anthropic. But then I did see an interview with one of the Anthropic co-founders who said that, yeah, that's true. The unit economics don't look great right now. We're losing money every year. But his point was that that's because we're releasing new models all the time. And so our CapEx spending is so big on the model that's coming next year, 10 times what we spent on the last one, that it dwarfs the revenue we make from the previous model. His point was that if you look at the P&L for a model itself, like Claude 4 or something, the investment in the model and the revenue generated by that model and the costs involved, I mean, it is a profitable model. It's just that we're always making new models. See what I mean?
Yeah, I'd say we're still in the log phase of growth where a lot of innovation's still happening. You can see that with the video generation, for example. If you look just 2 years ago, we had all these weird videos of people where their fingers were kind of bleeding out into space. And there's one famous clip of Will Smith eating spaghetti, which was just spooky. But now we're getting photorealistic movies where people talk as if they're real people. I mean, it's almost indistinguishable, I'd say, from reality.
Yeah, I think this generation's Turing test is the Will Smith eating spaghetti test. It's passing it now. But I don't want to end this episode, Romin, on such an optimistic note that this isn't a bubble. Come on. I think you and I both believe valuations are a bit stretched. Whether you want to call it a bubble or not, I don't know. But if that's the case, and there is a reckoning coming at some point, the question is when? Like, we know things can stay expensive for a very long period of time. So to put it in a provocative way and compare it to the dot-com bubble, are we in 1996 or are we in 1999 right now?
Personally, I'd probably go for 1996. And I think that's because we're still seeing a rate of innovation which is pretty rapid. So new use cases are going to come around. We're going to see more uptake of the existing models. We're not saturated, I wouldn't say. People are still getting on board with the technology and it's still bleeding into people's lives. But I think we are reaching the stage where it is slowing down a bit. And at that point, that's when the reckoning is going to come. If the earnings growth doesn't materialize and the spending continues, well, that's just unsustainable.
Yeah. Ultimately, I have no idea if we're in 1996 or 1999. I just hope we're not in 2006.
Now, this is moving so quickly, you probably want to keep abreast of these new innovations in AI. And recently we wrote about this in our newsletter, the Weekly Market Roundup. If you did want to sign up for that, it's free. It's delivered to your inbox on a Friday. And if you want to take a look at that, just go to pensioncraft.com/newsletter to learn more.
Okay, today's dumb question of the week. Are bubbles always bad? Now, I guess it depends what we mean by bad. Certainly they can be bad for investors, right? That's not up for dispute. They can be painful. But are they always bad for society at large?
I don't think they are, because whenever you get a brand new technology which is going to transform society, it needs capital. We saw it so many times in the past. Canals, railways, bicycles, electricity, automobiles, all of these things required capital and new infrastructure. So in a sense, there had to be a bubble in order to fuel that growth rapidly. Plus, there's a lot of excitement in society around these changes as we see things which we've never seen before. So I'd say these bubbles are a necessary evil, and there's inevitably going to be misallocation of capital as a result, and there's going to be a period of really painful consolidation, usually, plus a little credit wobble, maybe a not very small credit wobble. But these are just growing pains, I'd say.
I think you can look at certain bubbles in the past and say that in the long term, it was a good thing. Primarily because it built out this excess infrastructure, like you say, which later on becomes extremely cheap to use, and a lot of new businesses are built on top of that cheap infrastructure. So the dot-com bubble here is kind of the perfect example. We overbuilt fiber optic networks and data centers. Like, we did it too quickly. The revenues that were coming in didn't justify spending that much money so quickly. But the overhang from all that powered all these wonderful businesses we see today, which are now worth literally trillions of dollars.
So if we think about things like automobiles, where you have to have this fuel to make this thing run, where it's really difficult to get hold of, you have to drill holes in the ground, often in really weird places in the world. Then you have to purify it through this really complex fractional distillation process. And then you have to ship that refined product to where it's needed. A priori, you'd have thought, there's no way that's going to work. And yet, here we are.
Kind of works, doesn't it? Sort of.
It worked until it didn't. Okay.
Yeah.
So in that sense, these bubbles and the things that go behind them do scale the technology and they push down cost curves. And let's say that you just used organic revenue and organic growth in order to scale these things up. Well, it would take decades, whereas what we've seen with things like solar energy and things like battery technology for cars is that we've seen a really rapid uptake and, as a result, more rapid adoption of the technologies. And I think AI, to some extent, is no different.
I think there are two different kinds of bubbles, and some are clearly bad, whereas others you could maybe argue are good for society in the long term. So we've mentioned a few of the good things, where we kind of pull innovation forward by overspending today. But that becomes a bad thing if you're not building any real assets or knowledge. If it's purely a financial bubble built on speculation, the tulip mania kind of thing, that's not good. We're not going to build a new economy based on tulips in the long term. And I think there's also a danger where the popping of a bubble impacts the real economy so much that people lose their jobs and there's a systemic crisis, which is obviously what happened in 2008. But that didn't happen in the dot-com bubble. I think in the dot-com bubble, there wasn't enough interlinkages between those telecoms and internet companies and the banks. Like, it was largely being funded by equity, right? Whereas in 2008, the banks were up to their eyeballs lending to this stuff. They didn't even know what they'd lent. And households themselves were over-leveraged. So the unwinding of that was incredibly painful.
Yeah, so in a sense, if companies like NVIDIA are funding this new innovation, that's not a bad thing as long as the disruption that comes along doesn't disrupt NVIDIA, which is why my photonics example was one that would be quite worrying for this whole ecosystem.
But personally, let's say it goes wrong and NVIDIA's stock price falls 70%. I don't care that much unless it imperils a load of banks who then stop lending. We get a credit crunch, which means people lose their jobs and possibly their homes, and we have to bail everything out and the taxpayer's on the hook. Like, we'd rather this be a dot-com bubble if it goes wrong than a financial crisis. And I think we don't know the answer to that because we know there's some debt going on in the background. Like, there's a lot of private credit piggybacking on these deals. In some cases, lending against collateralized GPUs, that makes me slightly worried. We just don't know the scale of it, and we don't know who's holding all that debt necessarily.
But if you do look at the effect on the US economy of that big withdrawal after the dot-com bubble burst, then it had a huge impact for the US's performance in the global equity markets, but also economically. And again, what we see is that this is essentially, to first order, a US phenomenon. And if something goes badly wrong, it's going to massively negatively impact the US. That'll be the epicenter of the crisis. Now, for someone who lives in Europe, in the UK, where essentially it's a land of no technology, well, maybe this would be a good thing for us eventually. Maybe we'd come out of it okay. But I've got a feeling that as users of the technology, we may be dragged down along with everyone else.
Yeah, we've spoken in the past about how global equity markets tend to be highly correlated. Like, if this bubble popped, it would be probably pretty bad for the US market, but I don't think anyone's coming out of it looking great.
But how about this, Michael? How about if, given the UK's really good technology base and university system, how about if we came up with the innovation that would utterly transform this landscape? I wouldn't say it's out of the question.
I'd say we already did it. DeepMind was a UK company, which Google bought. No, seriously. I think we had the people, had the technology, and then we let it slip through our fingers. But to just wrap this up, my personal opinion is AI as a technology is going to be hugely transformative, as big as or maybe bigger than the internet. But I also think we're in a CapEx bubble, an evaluation bubble. Not to the extremes of the dot-com bubble yet, but to some degree. And I certainly wouldn't be surprised if there's somewhat of a market crash coming in the next year or two. But you said there that the dot-com bubble was really painful for US investors, which it was, obviously. But in the long term, the internet was revolutionary, and it was the US companies that came to dominate that. So I think you'd have to say that that misallocation of capital early on kind of paid off in the long term for the US market and economy. The same thing might happen here.
And this is one of the reasons why people say that if there was an implosion of the AI bubble, a lot of the infrastructure which is out there could still be useful. It's just that it would be mispriced and it would be possibly not justified in its scale. So maybe the next generation of technology that comes out of it would be the truly transformative one, by analogy with the dot-com bubble.
The one question I have in my mind still, and the difference perhaps with the internet stuff, is that once you've laid all the fiber optic networks, they're going to last for a long time. We hinted at the fact earlier that maybe that's not true of GPUs. Maybe this is a kind of business which is always going to be capital intensive, and therefore not such great news for investors. We'll see.
But look, I'm a sci-fi nerd, and so for me, this is just utopia. I can finally talk to my computer and have it talk back to me in a fairly cogent way.
Maybe it'll get sick of it one day and stop talking to you.
Yeah, that would be a real sign of intelligence.
Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a Pensioncraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.